My name is David Williams, and I'm super pleased to be here today with you for our Market Thoughts program. Thanks so much for coming. If you're new to Trader, you can ask questions in this meeting and you can make comments. Just type them into the GoToWebinar text box and I'll answer those for you. Our company is Trader. We're in our 23rd year of providing market forecasts for traders just like you around the world. Please be sure to read our trading disclaimer. Trading is risky. You can lose money, and so on. This is at the bottom of each of our website pages. So thanks again for coming today. Hope you're all doing well. A lot has happened in the markets, and we do want to talk a little bit about it. Yes, so much. I'll tell you, the market is in a peculiarly weak position. We're talking now about the S&P. Let's put that up for a minute. This is the bond market, which is also continuing to confirm our larger forecast. But let's get over to S&P and take a quick look. So ordinarily, the S&P would not be where it is today. This is an unusual posture for the market. And although it doesn't look like much on Friday, there are some things late in the day that happened on Friday that were unusual by a relatively large margin. I mean, kind of more than normally unusual. And what that can mean is that the market really is getting ready for a much, much larger decline. So we're going to be watching to see how today's session closes. The close won't definitively, absolutely, deny the further decline most likely, but it can go some distance in, sort of fixing the position of the market. So we are really interested in what all this plays out like. And this could, like I said, it could mean a lot temporarily to the downside. So you have to be very careful with long positions. Let's take a look at the intraday, the hourly, just as an example. And they've firmed up a little bit here. I mean, the market has moved down. We could easily firm up here and see some higher prices. And we, of course, sometimes will use our own intraday forecasts as a means of understanding whether the market is really weak or strong. So as an example, if we had a forecast for the market to move from this low, say up to this level, and the market really couldn't get to that level and turned like this, that would be a sign of weakness, right? That they couldn't get up to such and such level. So if that is the case, then we'll know that there's probably more coming to the downside. But I do think it's important to be a little extra cautious with the market under the conditions that we have on the long side. And, if they do recover well and maybe you would have missed a good long move, that's fine. Now we have new information. The market's continually changing its position and its information. And when the information changes, you may miss that move that shows you that the information has changed, but that gives you information about the next move. So you still have an opportunity to be in the market and do something with it. So it is really interesting how what they've done. We had a forecast for the market to move down to 40 from early today down to 45.25 to 23. They did do that. Today's low is 44.25 to 23. We did get down to 44.2275. So the 23 has been done. Normally there would be a bounce off of a completion like that, probably more than what you've just have seen here. So we're going to wait and see. But anyway, it's a very interesting posture for the market. And this posture, if it is going to confirm something really bad, then that would take us into next week. It wouldn't just be this week, probably. It would take us into next week. So we'll see. And then over here on the bonds, we had forecast that the bonds should decline from the current prices down to 143. initial target. They were at 150 at the time. So we really this was just a home run type of trade. They just banged them down really hard to 143. You'll notice it says initial target. There's a secondary target that we've put out for bonds as well that they should be reaching before the decline is over. And today we've gotten down to 141.27. So there still is more that we think the bonds are going to do. And they're trying to price themselves in accordance to a kind of unprecedented series of rate hikes of an unknown quantity. That's what the bond market is trying to price in. And that really wasn't a part of the trade per se, but it was in the back of our mind that, the technicals are really pointing to sharply lower prices, 7 full handles just for the initial target. It was a nice backdrop, put it that way, to say, hey, the bond market just doesn't know what the Fed's going to do, and it's going to try to price in and find value, at a particular level. We also had crude should likely decline to 94 from 106. And in this one, I did put out the secondary target. 89 to 88 is the main target. Now, we've only gotten down to 92.60, but we think in the second quarter of the year that, and we put this out on Ameritrade with Ben Lichtenstein, that crude should likely decline to 94 and then 89 to 88 in the second quarter of this year. We're in the second quarter. We've already done the 94, and we think 89 and 88 or lower is likely going to occur. So that's pretty important. Here's Friday on the right. This is the S&P. Now, it may not look really that weird. We were forecasting any further successful test of 44.45, which is this low. So we're talking about testing a support level. Will advance to 45.02 to 03, and then 45.08 to 10 into tomorrow. And they did do all that in that same day. They got up to 45.12 and even up to 45.17. And then that was the end of that day. And then there was a swing up. And this is the last period. This decline is not so weird, but this continued decline, the bounce and the further decline, that whole piece is not the normal posture for the market. And it gave us a pretty good clue that the market would be lower today. And then we're watching today to see if the market is really intending on going significantly lower than even this. So we're super interested in this, and I hope you are too. So these are the three main things that we've been watching and trading. There are smaller trades that we don't bother putting charts up for, but a lot of these are somewhat bigger indications for what the market's going to do. And as soon as we have a really good, clear idea what's next for the S&P, I have a pretty good idea, but I want to see how they handle certain upcoming events in today's session, just the intraday price events, if you want to think of them as that. I want to see how they handle those, and we'll put it all together. Let's see what's on your mind today. I don't have a lot of extra things to go over today, but I'd love to hear from you. Rob is here and he says, hey, how about the soybeans? Yeah, we were forecasting. Let me show you this. Let's go into soybeans here. So somewhere, here we go. Soybeans, we were forecasting that a weekly close below 1689 would indicate a decline to 1628 for soybeans. Last week we said a weekly close the week of April 4th below 1689 will indicate a test of 1672 during the week of April 11th. Now, this is the week of April 11th, and we did reach 1672, and we're below that now in soybeans. So the bear side of soybeans is still, even with the usual bounces, is still kind of in play for us after their big recent run up. So we're pleased with the decline. It seemed obvious at the time. It wasn't a difficult call And sometimes it can be a difficult call and you still make it. But this wasn't that difficult to say that they were in a weaker position. I'll show you here. Let's just start from, say, the monthly chart. So this is the monthly chart. Soybeans really spiked up. Here's the weekly chart. And then here is, say, the daily chart of soybeans coming down. And we said last week, if they close the week below 1689, well, they closed right at 1689. And so that also caused us a little bit of grief, because a neutral indication isn't bullish or bearish in most cases. It really is neutral, and it doesn't actually give a definitive signal. So that was a little bit of an issue, but we were calling for lower prices upon a failure at 1689. And today they've gotten down to 1652. So we've had a pretty good decline to the 1678 or whatever level plus lower, and we still think there's some lower coming. So I hope that's good, Rob. Richard's here and he says, to my mentor, oh, thank you very, very, very much. He says, thank you for everything. Thank you so much, Richard. I so appreciate you saying that. Really do. I really appreciate that. Ed is here and he says, David, at this point, would you say we have a failed reflected wave bottom inside of a weekly top, assuming we actually triggered a weekly top? Yes, that's one of the reasons I want to see the daily close today. So in the S&P, there are certain levels that if we close below, and if you know anything you do on reflected wave, you know that if we close below that level, that starts to further confirm the well-said indication that you have, which is a weekly top followed by a daily bottom, and then potentially a breakout of that daily bottom. That is not a strong position. So the market could be in a position for quite sharply lower prices. And that's what we're waiting on to see how they manage themselves later today. So thank you, Ed. Another Ed is here and he says, hi, David, if the larger decline does come, are we showing it will be a fast decline? Well, it would be, yes, generally speaking, I am, but not necessarily like sometimes where we say, hey, this is going to be a smash and grab to the downside. But the indication is partially off a weekly chart. From the weekly chart perspective, it would look like a fast decline. So, you know how sometimes if you look at something on a 5-minute chart, it looks like it takes forever to get down there. But if you look at it on an hourly chart, it was 2 really sharp, big hourly declines, right? 2 bars, but you were just watching it on a 5-minute chart. It didn't seem like it was that direct. So it kind of depends on the time frame you're looking at it. But from a weekly perspective, we expect it to look like almost like a smash and grab to the downside if it confirms. But weekly is a long period of time for most day traders. And I've said many times, and I'll say it again, there's tremendous value in the longer term, even though you may not know it or be trading the longer term. There is tremendous value in the longer term for determining things that are going to be happening on much, much smaller timeframes and indications. So there you go. Connie is here. Hi, Connie. And Connie says, what level must be for a weekly bottom in the S&P? You know, I honestly don't actually know off the top of my head, and it's for a little bit of a complicated reason. The way that we set up reflected wave on our charts is a little bit slower as a way of speaking. It isn't as easy to trigger it. And most people that have reflected wave did trigger a weekly reflected wave top last week. And we've set ours up to show that. But the fact that we didn't trigger it the regular way that we use it, which would have required a little more, actually can add to the potential weakness of the overall posture of the market. So the reason I'm answering it this way is because on our chart, since we didn't actually trigger a weekly top, we don't therefore have a weekly bottom we can go to. So reflected wave is kind of off the table for us. Now, for those, we've set it so that it's like, and for those of you who might have reflected wave and want to know what I'm referring to here, you can call me and I'll explain it. It's very easy and I'll show you what we do. But if you did trigger a weekly top, then you will be able to get a weekly reflected wave bottom. I'm just not sure of that price level, what they would have to go to, Connie. Just at this moment, I haven't looked at it to see what it is. But either way, what's equally important to us is that there are price levels that would have to be reached during a big decline like this, or a potentially big decline, if they confirm. And then we're going to watch for that. So Samuel, thank you, Connie. Samuel's here and he says, are you looking for a particular close to determine whether or not the market is going lower? Yes, we are. I just put it all out this morning, and honestly, I don't want to put it all out here right now, but I do want to say that there is a daily close today and potentially tomorrow that we would want to see below a certain level that would further sort of confirm or cement our outlook that the market is in a dangerously weak position suddenly. Like, whoa, out of the blue. Just on Friday, the last couple of hours of Friday, 2 or 3 hours of Friday, did some things that we thought were very abnormal for the overall condition of the market. Now, remember, there really is nothing abnormal about any market movement. The term abnormal means that simply that we wouldn't normally have expected it, but it is normal for the market because the market did it. So I'm just want to make it clear that we sometimes, don't see something that is about to happen, and if it's a big thing or an important thing, it can really change our outlook. So this is one of those things, and today how they close and all that will be important. I'll give a little more information about it tomorrow if you're here and we can go over it. Thank you, Samuel. Ed is here and he says, also any indications for the euro that you can share? We don't have a position on the euro, but there are things that the euro could do this week, and I can go into this a little later in the week, to close above certain levels that would get us interested in a long position. But we're not interested in a long position right now under the current set of conditions the market has. So there. And then Daniel's here. Hey, Daniel says, anything new for Lucid? Let's put Lucid up. So we switched Lucid out for, this is a 15-minute chart. Let me go to a daily for Twitter. Oh, this is the daily. So this is Lucid right here. Let's take a look at Lucid just for a minute here. This is kind of the biggest chart. This is the yearly chart of Lucid. So in their second year, they first went way up to 57, and they made a low of 16, and we are trading at 21. Let's go to a quarterly chart of Lucid. So you can see Lucid's not in a great position right now. This is actually surprisingly weak for Lucid. It's a surprisingly weak position. There are certain things they could do to help fix their position, but they haven't done it yet. I really like Lucid in terms of the company and their product, but their stock has not yet really reflected a bright future just yet. So this is the monthly, and it may well at some point. But when as an example, the square principle, and tomorrow we're going to have another square principle webinar. When the square principle, it is something that if they firm up on a certain square, it starts to have meaning for the market to then go higher and so on. Also, I don't remember the number, but Daniel, we had made a forecast that we were kind of forced to make because when we have our webinars, sometimes by the time 12:30 comes, 12:30 Pacific time, we are out of, the forecast is almost completed already by the time we have those meetings. We had something for Amazon to get up to something higher than 33.67. I don't remember exactly the price, but it might have been 33.90 or something, but they missed that number. In other words, they weren't able to touch their square, and that produced this kind of shocking weakness. So when markets can't reach an important square, that itself can be a signal for an important reversal or an important just directional move. So Amazon and a bunch of the stocks that we follow, Amazon, Twitter, Tesla, Apple, they've all today and probably in a day or so have or are reaching numbers that we've been calling for on the downside based on their own indications. You can take indications from other markets. You can be a intra-market analyst, where you can do analysis on more than one market and make decisions based on multiple markets and what they're telling you, sort of a much more bigger holistic picture. And philosophically, if you will, I'm totally on board with that. The only thing is that in real practice, I have found, just for myself, I have found that it appears to me that I get better indications from the market itself that I'm trying to forecast than I do from what other markets are doing, either contra to that market or in concert with that market. So I haven't had great success looking at the S&P and juxtaposing it against, as an example, bonds or any of the other classic markets that go contrary to each other, and therefore set up conditions that you could know something have a little edge in the market. I've actually found that the market itself gives me, the one market that I'm trading gives me the best indications for what it's going to do. But philosophically, the more holistic the picture is, the better. I just tend to think, though, that it's pretty highly specialized to be able to look, and people can do it, to look at other markets, see their current position, look at the market you're thinking about trading, and be able to understand what really, with a high degree of likelihood, you should be doing with those two markets. Should you be long one and short the other, short one and long the other? Or should you just take one of the indications and just go short one of them? What do you do with that information? And just for however my perception works, it seems like I get better indications just from the market that I'm actually trading, like the S&P. I never look at other markets, as an example, to get an indication from the S&P about what I should do in the S&P. I just look at the S&P and get that indication. So we're still bouncing off of the 23, the downside 23 target. And any of you that know the square principle can probably work out why 23 was important to us in the decline. Today's low is 22.75, and they're still doing, they're giving a pretty good bounce off of it here. And that bounce could continue. It's slow, it's a grind. We're not really doing a lot with it. And I'm not super interested in long positions today. I am interested if the market can go up to certain levels only as a means to judge the condition of the market. So I hope that's useful. Let's see, for Lucid, it's 4423 a square roadmap. I think it's square principle, Thomas, that we were using for that. John is here and he says, is there an extra charge from my spouse at the square principle seminar? I don't believe so. There might be a little something because if she's there, she's welcome to come. You'd be best calling in, because I really, at this moment, we've had people bring their spouses before, and I don't want to speak out of turn and say, yes, there's a little charge when there really isn't anything. If there is any charge, John, I mean, like really, even if it was tiny, it's related to the Mirage and their room and the food and all that. It's all related to consumables that are there in the room. And we would love to have her eat, there's a 5-star meal that we have when we're there and all that. It's really nice. But we'll go to whatever length we can to make sure that there's no charge. But if you want to call in and ask Trina or Cheryl Lee, they will know what the details are on that if you bring your spouse. Okay, so no worries about that. Please don't worry about it, and call in, and hope you are coming. That'd be great. Connie also says, when are you on Ameritrade next time? We're waiting to hear from them right now. Trina did contact them last week, and I'm hoping to hear from them soon to get back on, because since we were on last time, the crude oil forecast, the crude was coming down from 105 for the 94. That's been taken care of, and we still have lower prices to come, as you know. Thanks, Connie. Timothy's here, and he says the S&P did not hit an important up target off the monthly reflected wave bottom, became real close. Are you still expecting that target to get hit? I'm not certain which target you're referring to, Timothy, without going to the monthlies and so on right now. But a lot of what our next thing is going to depend on whether or not it all kind of ties into the week of April 18th. So next week is the week of April 18th. And on that week, there are important indications. It is plus or minus a week, but the on-time week is April 18th. And there are decent numbers of indications for that week for us. If the market is really not in very good position, talking about the S&P, then we won't expect to see any of those targets, whatever it is on the upside, get reached, and instead see the market be moving down pretty dramatically. Again, it's not really normal what they did on Friday, but it's a big signal that we are taking very seriously until further notice. Additionally, some newer work that we call, I don't even really know what the name of it is, but when markets get into what we could refer to as a conflict period, and conflict doesn't mean like the war between Russia and Ukraine, it means internal conflict in the market. When that happens, internal mathematically conflict, when that happens, the market has dramatic, sharp moves. And I'm going to try to explain this. Last week, the market was in a move up inside a conflict period for one more period up to complete the run that the conflict would be based on. But instead of that, late on Friday, the market moved back down, and it got to the level that would invalidate the original conflict period even existing. And that level is 44.83. So Friday actually closed at 44.83 and change on the intraday chart. So that's not a normal position when the market's in a conflict period to be at. And so that negated the conflict period on that smaller time frame. And now we see a conflict period that would take us into the week of April 18th on a larger time frame, in part due to this. It's kind of hard to verbalize it better than that. But if we don't close well and the market doesn't do well, then we're going to be leaning on this larger conflict period, which would not have been in play if the market would not have come back to 44.83. So there's kind of a sequence, it's kind of sequential. And the fact that they did come back to 83 negated, and we told everybody that the market should not come back down to 83, otherwise the whole thing is negated. In doing that, it actually opened the door to a larger, more important conflict period that takes us potentially into the week of April 18th, which is next week. So it's kind of ugly. It's like, wow, we just went from we're on our way up to finish a beautiful, indication to no, that indication's off the table. And now there's an even larger indication potentially to the downside. See? So that's the big spin around that we are dealing with. And that's why we're just simply not going to take long positions in the S&P until we have more clarity that this larger conflict period for a bigger move is not underway. And here we are near the lows of the session again. The market is not, doing well here. It's still under a great deal of pressure. So I hope that explains what happened between the last couple of hours of Friday, 3 hours of Friday, and into today. A smaller indication failed in a very unusual manner, and that set into a motion a larger, same kind of thing, conflict period indication from a much larger scale that so far the market is acting like it's under a very, very large pressure to the downside. So I hope that's good. You know, the naming of these things is sometimes a little unfortunate because I'm not really naming them as a means to describing them under those names to people, but I end up doing that. So there you go. That's what I call it, is because there is a conflict that takes place that the market will burst out of that area. And that's what we're thinking into the 18th. Thank you, Timothy, for your question. Thomas is here and he says, what were you originally expecting the market to do on Friday, 4.8? To go up to 45.24 to 45.26 would have been the normal place for the smaller of the two conflict periods to resolve itself. And on the way there, they got to like 16 or whatever it was, and then suddenly turned down and went back to 83, which is what negates the original smaller conflict. And that's a really peculiar place for the market to be. And then we had the follow through to today and so on. So thank you, Thomas. Samuel's here and he says, I know you aren't into fundamentals as much, but do you think the bank earnings would lift the S&P towards the end of this week? It may. And there's nothing wrong with fundamentals. There are people who can trade fundamentals. So yes, I think the answer is, yeah, you could see that. And this is, you know, seasonally, you have this week is seasonally, could supposedly would be a bullish week because it's Good Fridays on Friday and so on. But you have to be careful with seasonals because for a number of reasons. But one of the things that seasonals can do is they can do this into Wednesday and then do this into Friday. And you say, well, see, they were bullish into the holiday. But in order to get to that position, they had to do this. So you can't just go into a week like this. I know you guys all know this. You can't just say, well, it's, you know, it's a bullish week and we're just going higher. Sometimes that happens, but you have to be, especially under the conditions that we have, you have to be extra careful. So there you are. Let me see if there's anything else here from you. Any thoughts on Amazon? Yeah, I don't have a lot of new. We didn't do anything new with Amazon today. We're really relying on the index more or less right now to show us what it needs to show us. Thank you, John. William's here and he says the food is really wonderful. Thank you, William. That's great. William's been to the seminar and he's telling you that the food is really great there. It really is. I mean, it is just, you know, you won't eat any better than that while you're in Las Vegas when you're at the seminar. Thank you, William. I really appreciate you saying that. Connie also says, so if we go much lower in the S&P, will we see 47.20 this year? Yeah, we can still, all that can happen. It is a good way of restating your question is what happened between Friday and today potentially enough to take 47.20 off the table for the third quarter? Not now, it isn't. And even if it hits the targets that we've given out, that won't be enough to take it off the table. So, but it is weird enough to give us a minute's worth of pause about the bigger picture. So we'll update that a little bit as we, you know, as more things come to fruition here and so on. So I hope I've explained that. You know, one of the primary things that maturity in the markets looks like is that you're willing to wait your turn for clarity about something rather than having that really exciting push to just be in, which you sometimes will regret, you know, that you even got, you know, pushed into something like that. So waiting your turn is a big part of doing well with this. And at some point it becomes really clear that it is your turn and it's time to be long or short or something. You'll do much better with that. There certainly are going to be those days where you have a really good, exciting buy in the market. It may not even be your turn and it still works out. And that's great. The only problem with that is that it doesn't stop you from doing it the next time. It kind of teaches you to do it the next time. And that's what we're trying to avoid, is trying to, it's kind of a form of guessing. So is it also true, yes, that sometimes if you wait too long, you lose a big portion of the move is already over, and so on. But it's probably better to think in terms of waiting your turn than it is to saying, well, I'm always going to get in early and sit through whatever stuff goes on. There's just it is a kind of maturity, and by maturity I simply mean a kind of normalcy that you get to, that you're really not too excited until you see what it is that you really want to see. So there you are. That's maybe the best way of saying it. Over many, many long years of doing this, because most people are only too excited. They just can't wait. The market opens up and they're either long or short right away, or they're whatever. And maybe there was an indication there for them. But learning to wait your turn for things that you understand and that you've put together takes time, takes practice, and a very normal sense of just being a normal person, trading an idea that or investing in an idea that you really like. So there you go. That's what I would say to you. So I hope some of this is good for you. It says thought-provoking a little bit anyway. And I don't want to also dissuade anybody. I mean, in my opinion, you have to be very careful with long positions. But if you have indications that you should be long, then you should follow, you've waited your turn and you should go take those. Don't let me dissuade you from those. I'm just pointing out what we happen to think here and what concerns us. So there you go. I hope you can be here tomorrow. If everything's good, we'll be able to have our meeting. And thank you so much for coming. And I'll see you all here tomorrow. Stay well. See you then.